today's Thursday, on Tuesday, that we would finish up Chapter 4, talking about Iowa withholding and how that is calculated. And then also take any questions that you guys might have about homework and that. So Iowa, obviously Iowa withholding is not covered in your textbook, so this is just kind of supplemental. And as I had mentioned earlier as well, that this is going to be changing as we move toward a flat tax in the state. This formula won't really be necessary anymore, but that's not for a few years. So just to kind of give you a little bit of experience with how the Iowa withholding formulas are used, you'll see that the concepts are very, very similar to what we have for federal. We have tables that are used. We have a wage bracket method and we have a percentage method for Iowa. Same, restrictions would be on the wage bracket method, that the table's only going to go up so far. Iowa does still have these, they call them allowances. I think they still call them allowances. Let's first look actually at the W-4. Now you'll see this says 2023. I searched for 2022 and I couldn't find it. This hasn't changed though. This is the same. So when employees are filling out their federal W-4 forms, they're also going to fill out an Iowa W-4 form. And if an employee changes their federal W-4 information, they're probably going to want to fill out a new Iowa W-4 form as well. Because chances are, like if they got married or they got divorced or anything like that, it will change how Iowa withholds on their income as well. So you'll see for Iowa here, you've got two choices. So this is the W-4. You got two choices, single or married. All right, so Iowa still has kind of that older, even though there are actually 6 filing statuses in Iowa, and you don't have to use the same filing status in Iowa that you use for federal purposes. Now, you have to use the correct filing status. You can't say you're single if you're married in Iowa and change that, but there is this kind of weird, there are 4 different married filing statuses in Iowa, or might be 3. There's married filing separate, there's 3, sorry. Married filing separate, so you got 2 separate tax returns. You've got married filing jointly, so you combine all of your income. And then we've got this 3rd category for married that is married filing separately but on the same tax return. So you've got, if you're at all familiar with the Iowa tax return, there are 2 columns. Like whereas with the federal tax return, there's only 1 column for income information. But on Iowa, there are actually 2 columns. There's one for the spouse and one for they call it the taxpayer. So whoever's name is first on that tax return. But this, even though we have that extra filing status when employees are filling out their W-4 forms, it doesn't really matter. They're either married or they're not married, right? And you can see there's no head of household choice here. There is a head of household choice on the federal or on the Iowa tax return, but on the W-4, it kind of has that same feel as the old that 2019 and earlier W-4 form for the federal government, because Iowa adopted most of the changes, tax changes in 2017 that the federal government passed, but not all of them. There's still some things that are kind of different with Iowa income taxes. So this happens to be a fillable form, so you can actually put the information in there. Again, name, social security number, address, all of that. There's also this question of being exempt, like we had on the federal. So if you think you're exempt, won't have to pay, meaning you won't have to pay or won't owe any Iowa income taxes, then you can write exempt there. Now you can see we've got, let's see, there are some special ones too, like military spouse exemptions and things like that that you don't see on the federal form. The Iowa form is a little bit more complex, I think. Iowa taxes are actually fairly complex for states when you rank them the states by their tax complexity. Iowa is they're not easy. We're moving toward being easier, but right now the taxes really aren't that easy. So here you can see personal allowances. So just like that 2019 and earlier method for on the federal level, we've got allowances still here on the Iowa form, because Iowa still has what we call exemptions on the tax return. So remember I said that those allowances sort of related to those exemptions that the federal government used to have, but they did away with it because they did away with the exemptions. Iowa still has exemptions. And so they still have allowances. Now for Iowa, there are all sorts of different ways that you can qualify for additional allowances. And if you were to go through and actually do the calculations for withholding and you played around with it saying, okay, if I had 10 exemption or 10 allowances, what would the withholding be? If I had 12 allowances, what would the withholding be? What you would find is that there's a very small difference in the actual withholding that takes place. But Iowa, there are individuals who go up to 20, 25 allowances. And you'll see, so on the second page, there are some worksheets to help calculate the number of allowances. So yeah, go ahead, Lisa.
I'm sorry. You was talking about that there were 6 statuses, 3 for married, but they don't have head of household. So
No,
what
they
would
do have they do have head of household for a filing status. What I was pointing out was, yes, there are 6 filing statuses on the tax return for Iowa, but on the W-2, or I'm sorry, on the W-4 that employees fill out, there's only 2 choices, married or single.
Oh, okay. All right.
Yeah, but there is a head of household filing status on the Iowa tax return.
So on the form, they would have the 3 for the married, head of household, the single, and then what's the 6th one?
Married filing separately on a joint return.
Right, but that's one of the 3, right? There's
Yes.
married
So
filing
there's also widow or widower.
Okay. Thanks.
Yep. We oftentimes, but that one's not obviously not used quite as frequently, so it's easy to forget that one. Okay, so we've got personal allowances, and you'll see there's a worksheet on the other side here to calculate how many personal allowances there are. Allowances for dependents, and 1 allowance for each dependent you claim. Allowances for itemized deductions. So if you're going to itemize your deductions, and I tell you, more people itemize their deductions on the Iowa return than do on the federal return. And the reason for that is, so you always have 2 choices with regard to deductions. You can itemize your deductions, which means you list out specifically each eligible deduction and total them up. And what those deductions do is they reduce your taxable income. You can do that, or you can take what's called the standard deduction. Standard deduction is based on filing status, what your filing status is. But that standard deduction also reduces your taxable income. Well, in Iowa, and so you're going to take whichever one is most beneficial, standard deduction or itemized deductions. At the federal level, the itemized deduction, the standard deduction is pretty high. It's a large number, and for most people, I think it's between 80 and 90% of taxpayers now, they don't itemize their deductions at the federal level. They take the standard deduction because it's more beneficial. But on Iowa, the opposite is true. The standard deduction is super low. So many, many more people do itemize their deductions in Iowa. So even though if you're doing your taxes or taking your taxes to be done by somebody else, and you say, oh, I'm not going to itemize my deduction, so I'm not going to bring any of this detailed information to my tax preparer. I'm not going to enter it in. Well, that may be the case at the federal level for your federal tax return, but it's probably still more beneficial for you to itemize on the Iowa return. So you may still want to have all of that information handy, those itemized deductions. But that is one of the corresponding allowances on the Iowa are those Iowa itemized deductions. Any adjustments to income? Iowa has a whole separate list of adjustments to income as well. These are things that either increase your income or reduce your taxable income. So any of these things would also provide additional allowances, but you can see there's a special calculation here. So if you have, let's see, payments such as an IRA, these are all retirement plans, penalty on early withdrawal of savings, student loan interest, these are reductions. So if you contributed to any of these, or if you paid like a penalty or student loan interest, you total all of it up, divide it by 600, and then round it to the nearest whole number and enter it on line 4. So that's an additional number of allowances, and it's based on the actual amount that you pay toward that. Child and dependent care credit, if you're eligible for that in Iowa, you would. And again, the requirements for meeting eligibility for this credit is different in Iowa than it is at the federal level. So these questions are just pertaining to Iowa, not are you eligible for it at the federal level, but are you eligible for it at the state level? And then, so all those are totaled up, and then any additional amount that you want deducted. So we saw that on the W-4, the federal W-4 as well, and then signed again under penalty of perjury. And then the employer's information here. Now, all of the instructions, what I just kind of went through very, very briefly, there's much more detailed instructions on the back of the form. So the Iowa form is actually probably more complex than the federal form, but it is one of those things that has to be filled out by all employees. It gives you, so the second page here gives you all that additional information. So personal allowances. What is a personal allowance? Well, each individual on the tax return gets personal allowances for, so one for you, one for your spouse, and then there are allowances for dependents as well. If you have 3 kids, there's 3 additional allowances, and then you go through and figure out all of your so itemized deductions. Enter what you think your itemized deductions are. So you kind of have to do like a pre-calculation of your tax return, really. So if you think you're going to have $6,000 of itemized deductions, you would enter 6 in there, enter the standard deduction, and they enter it. So this one actually is for at the federal standard deduction that they're using. And then there's a calculation for dividing all of that up, and that gives you the number of allowances. Yeah.
So is there like a list of itemized items that you can deduct it?
Well, you would, there is, but you'd probably have to reference the instructions for filing your tax return to get that. Now on Iowa, most of them are the same. So like medical expenses, mortgage interest, taxes paid, state taxes paid, local taxes paid, charitable contributions, what else? That's kind of pretty much the gist of what we have these days. There used to be a whole lot more, and there are a lot fewer these days. But they're generally speaking the same ones that are eligible at the federal level. But like I said, that standard deduction is different. So even though you got the exact same itemized deductions for federal and for state, you might not need them at the federal level because you're going to use the standard deduction, but you're probably going to want to use them at the state level because you're not going to want to use the standard deduction necessarily. Many people still do, but because of the lower, that lower level, more people itemize. So yeah, you'd have to probably reference the instructions for the tax return. And then there are specific instructions for the child dependent care credit. Again, these only to Iowa. So you go through, calculate all of that, follow the instructions to indicate whether or not you are entitled to any allowances. Just like at the federal level, allowances for Iowa, the more allowances you have, the less your withholding is going to be. Okay, so there is that inverse relationship at the state level as well. Now, if you remember back in chapter 1, I think it was, we talked about all those different laws and all those different regulations and things that the payroll department and the human resources department have to do. And one of those things was they have to report new hires within a certain period of time in order to determine whether an individual is liable for child support garnishment, right? So, and that has to be sent into the state within a certain period of time. Well, as part of the W-4 form in Iowa, they have this additional form that employees have to fill out that pertains to that particular law. So this is for the child support garnishment, new hire reporting. This gets filled out both by the employer and the employee. So we've got a section here for employer information. And we've got a section for employee information. They want all sorts of information here, dependent health care coverage, date that the employee started, date of birth, all of that stuff. This then gets sent in to the centralized registry for the state of Iowa, and they will go through and look and see if that employee is subject to any type of child support garnishment. And if they are, then they will send a notice to the employer, to the HR department or payroll department, indicating how much needs to be withheld from the paycheck. So they give you pretty detailed information about what the calculation is for the withholding on that. So, and then there's all the instructions for that. Okay, so this is the Iowa W-4, and of course this information that we gather here is then applied on a per pay basis to indicate how much withholding is going to occur. Now, I know this is really, really tiny. Let's see if we can't make this bigger. So this probably looks kind of familiar. There's a table. And we've got down here, they have this in an Excel format. That's still pretty small. So daily tax table. So if you were paid on a daily basis, weekly tax table. Again, why do I have to do that more than once? Let's see, I don't know, I want to see how far up this goes. This goes up to 1,980 on a weekly basis. Bi-weekly, monthly, semi-monthly, annually, all of them have their own tables. A number of allowances up at the top, and then wage range down over here at the side. Again, this is for January 1st, 2022. So right now, employers would be using a 2023 table. Okay, those withholding amounts, well, not that much here, but these are going down. I don't know if any of you have noticed, if you've received any paychecks yet this year. If you take a look, if you are receiving a paycheck and you have stubs from this year and you have stubs from last year, compare them. If your income is not changed, you will see that even if your income has stayed exactly the same, the amount of withholding that is occurring at the state level has gone down. That is a reflection of the tax rates going down. Okay, so that is being, that's being implemented at the withholding level, at the paycheck level. So if, you know, take a peek, and you can see. So these, the tables, obviously the tables for federal didn't have, they were rounded to the nearest dollar. These have cents, right? Even though, again, at the state level, when we actually prepare a tax return, we're rounding to the nearest dollar. So, but we do use that. So again, withholding allowances up here, wage levels over here. This is, and only if you go up to a certain level of income. So if you don't, if you have to use a, if you cannot use the wage bracket method and have to use the percentage method for Iowa, then you have to follow these steps. There are several steps here. They actually give you, they do it a little bit differently in that they give you equations to use. Now you have to figure out, they give you the, I don't know why they don't just say it up here instead of putting it in parentheses, but so step 1, G minus W, so gross taxable wages, minus the federal withholding amount for the pay period. So you do get a deduction for how much you're paying in federal taxes. That's because, again, if you look at your Iowa tax return, federal income taxes paid are deductible at the Iowa level. So they're taking that into account when they're calculating the withholding. So this is just your taxable wages minus how much withholding has federal withholding there was. Next step, and gives you, so you're going to take T1, which is the result from the first step, minus S. What's S? S is the standard deduction for the pay period. All right, standard deduction amounts. They give you a table down here. These look kind of familiar. Not exactly the same amounts, obviously, but we've got a specific standard deduction amounts that we get to then subtract based upon our frequency. Now, there's, if you have 0 or 1 allowance that you claimed on that W-4 form, you would then use the corresponding frequency of pay, and there's your standard deduction. If you have 2 or more, then this is what you're going to use. So standard deduction, subtract the standard deduction from your result in the first one. And then step 3. And we're going to take what our result was here times R. R is the withholding tax rate. So now we have to reference the chart. Let's see, where's the chart part of here? Okay. So you would reference down here based upon, and again, this looks familiar, right? Very similar. You would apply it to the correct frequency of pay, and then the amount that was in that T2, and you're going to follow the instructions across the line. So that is, those are our rates. T2 times R equals T3. Then we're going to take T3 minus C. C is the deduction amount per allowance for the pay period. N is the total number of allowances claimed. All right, so the number of allowances that we claimed that we listed on that form, we're going to multiply it by the appropriate number here. And then we're going to subtract that from that result in the previous step. Okay. Let's see, last step here, any additional withholding requested. Now we're going to add that to the amount. Okay, so fairly complex, lots of steps to it, but the instructions are fairly clear if you're careful in reading each word in the instructions. Okay, you are not going to be tested on Iowa. Okay, you're not going to be, there's no test question related. I don't ask you to calculate anything for Iowa. But I do need to make you aware of what those rules are and how how you calculate that. So they got some examples here as well of all of those steps and how it would work. You can look at that yourself. I think I've got this. Yeah, I've got this form listed up in. Oops, I'm in the wrong. There we go. In chapter 4 folder, under the resources tab, there is the, oh, do I actually have the 2022 here? Oh, well, that was the 2022. The instructions were 2022. That W4 is what I couldn't find, the 2022 for that. But it is there, so there's a link to it. Questions? Any questions out there? Let's see what Kenya has come in. No? All right. As soon as I said you're not going to be tested on it, you're like, oh, that's it. Never mind. Okay. But I do need to, it is part of the competencies for the course, so that's why we need to cover that. Give you some information on that. Okay. That out of the way, then, any questions on, any homework questions before we get started on chapter 5? Hopefully you started on homework.
Well, it's not from homework, but can you tell me like the letters of the forms, like W2P or W2S?
Oh, so the,
Aren't they all online on the IRS list? I downloaded some, but I'm not aware of all of them.
okay, so let me pull up, sorry. Gosh, it would help if I was in the right class. Whoops. So those information forms, is that what you're asking about?
Yeah, sometimes the forms has like a letter.
Right. Okay. So when it's got a W in front of it, it is going to pertain to the employee's income. So like the W-2 reports. So we've got the W-4. I don't know why. It's hard to erase. Okay, so remember the W-4 form. This is our withholding certificate. Whoops. Okay, this is filled out by the employee. And the W-4 indicates withholding per pay. Okay, so that's the W. It's really easy to get the W-4 and the W-2s mixed up. Even those of us who have been working in it for years sometimes still interchange these terms. So that W-4, again, filled out by the employee. W-2 is our annual I don't know how they actually title it. So this is it, and it's a summary of income, taxable income, and tax withholding. So it, and that's all the taxes. So Social Security tax, Medicare tax, federal income tax, state income tax, local taxes, all of that stuff. It is, the employer completes this. And they give a copy to the employee. It's used for tax return preparation, used by the employee to prepare their taxes, right? Their individual tax return. Okay, that's the W-2. Each employee gets one of these. It's on a per employee basis. Okay, so Daniel would get one, Kathy would get one, Ben would get one, Alex would get one. So you get it. Every individual would get one of these. The W-3 summarizes, or it's like a compilation of all W-2s issued. Okay, so it totals up all of those W-2s and puts it on one form. So it's not on a per, it's for the entire company.
So this is the employer.
This is the employer, right? Again, the employer completes this. And it is sent to the IRS. Copies of each of the W-2s is also sent to the IRS. Sent to the IRS, Social Security, and kept by employer. I don't know if some states have it sent to them. That could be Iowa. You don't send it to, last I knew anyway, you don't send it to Iowa, and you don't send them the W-2s either. But like I said, Iowa and the IRS talk to each other. W-2, and I know your book probably talks a little bit about like a W-2C. Does it mention a W-2C and W-3C? The C stands for corrected. So if you made a mistake on an original W-2, then you would file a W-2C. So
I could ask about W-3C.
there's also a W-3C. So C equals corrected.
So any C on any of the forms,
Well,
or just?
they're not always called C. Because sometimes it's called amended. So X stands for amended. It means both of them mean you made a mistake. I don't exactly know why. Maybe there's some difference. I don't know. But the C ones, yes, it's corrected. So if you made a mistake on an employee's W-2, you would issue a W-2C. You would again you'd give it to the employee, and you'd send it off to the IRS and all of that. Now, if it was a mistake in the amount of income that they earned or in the amount of tax, then you would also file this W-3C, because the information on there is going to change. If it was a error with regard to an employee's, like say you got something wrong on their social security number or their address. Now, usually an address doesn't really warrant a corrected W-2 because you can still use the information on it. But maybe you got the social security number wrong. Somebody data entered it incorrectly. Well, that social security number isn't going to go on the W-3 anyway. So you don't need to issue another W-3, but you do need to issue a corrected W-2 to the employee. I shouldn't say you need to. You should. Employees, what they can do is just kind of, when they're filling their tax return out, they just kind of overlook that and say, if the IRS ever asks them about it, they can say, well, it was wrong. But anything related to a change in the amounts of income, taxes withheld, anything like that. That would warrant both a corrected W-2 and a corrected W-3. Now the X is for, so like the 941, we know what the 941 is. Well, we can issue, and by the way, chances are if you have to issue a new W-3C or a W-3C, you're probably going to have to go back and amend the 941s as well. And you really hope it wasn't in the first quarter, because it means you very well may have to amend them going forward as well. Not always, but you might. It just depends on what the, yeah, it depends on what the error is. You're gonna have to amend the one.
Carries forward.
There are amounts that can carry forward. Like imagine if you, well, this probably wouldn't warrant a corrected W-3, but if you reported the wrong amount of income in a particular quarter, that means you very well may have, so first quarter, you underreported by $100. You actually paid that income in the first quarter, and you counted it toward the second quarter. So now you've got a couple of quarters. There are instances where you have to do it all over again, and it's kind of a nightmare. But the 941, we don't call it a 941C, we call it a 941X. Okay, so are we done with this?
Yes.
Okay. And the X, they also, if you've ever amended an individual tax return, like you filed your tax return and then there was a mistake on it, or you got more information after you already filed it and you had to change your original tax return, it's not called a corrected one, and you don't make a change on the old one. It's called a 1040X, an amended tax return. Again, I don't know the difference between corrected and amended, what that is, but 941X is an amended 941. So you made some sort of mistake on the 941 and you got to fix it. Again, chances are you probably also have a mistake then on a W-2 somewhere. You probably also have a mistake on a W-3 somewhere. Oftentimes we'll find this out when we're doing that end of the year reconciliation. Remember I said we have to match, the W-3 has to match all 4 quarters of the 941. Exactly. It has to be to the penny. So if there's some sort of difference, that's usually where you'll find out that, well, either your W-2s were wrong or your 941s were wrong. Then you've got to figure out, okay, where did I go wrong on this, right? Presumably software will help to mitigate a lot of this, but we all know software is only as smart as the person entering it. I shouldn't say smart, only as accurate as the information is going into it. So I don't know if you've heard that term, garbage in, garbage out. So if you don't put the right information in.
Like Excel.
What?
Just like Excel.
Yeah, exactly. Exactly. You've got to actually put the right information in. So the 941X is an amended 941. You're fixing a previous 941 that you've already filed. If you haven't already filed it, don't do this one. Just throw the old one away and do a new 941. So like you're ready to mail it off and you figure out you made a mistake. Don't mail it, just do another 941. Now there's also, and we're going to find this next chapter, there's a form 940, which is for unemployment reporting, unemployment tax reporting. There's also a 940X. Whoops, 40X. Again, amended. So once again, if you made a mistake on a 941 and you have to amend a 941 and you've already filed the W-2s, And the W-3, there's a good chance that you're gonna have to you're gonna have to correct those. You're gonna have to amend the 941. If you've already filed the 940, there's a chance that you might have to do an amended 940 as well. Okay, so all of these, yeah, if it's got a C behind it or an X behind it, it means you're fixing some error. Right? Were there other forms though that you wanted me to go through?
Well, besides the letter C, it was P, like W4P.
Which one, B? Sorry.
So in the homeworks, there are like more letters besides C.
In the homework?
So I don't know
Okay.
if in exam will be like the same.
Oh, let's see here. So, do you have like a assignment or a question number that I can take a look at?
I think it's from the quiz. No?
Is it from the quiz?
I'm not sure.
Oh, you mean the assessment?
No, the extracurricular question.
Oh, so the extra, like the adaptive study? Because there's the adaptive study and then there's
The one that
the
has like 20 questions,
videos,
not the videos.
the adaptive study.
Mhm. Because you have to answer some questions about the ECB or the something.
Let me see what they're, or if they're just trying to throw you off. Okay. All right, so it looks like there's 20 questions. Something sounds really dramatic. So there's a question about payroll income tax withholdings are reported on, and it lists the different forms. So you can do more than, you can only do one? Oh, no, not this one. So that doesn't have a C or A or anything on it. I don't see anything with a B in that anyway. I don't even see anything with a C. Oh, wait. Is it W4S? Sambit is married with 3 kids and just began a new job. He must, if it's this one, I think they're just trying to mess with you.
Well, it's okay.
Hmm?
Well, it's okay.
Okay, is that, but you said, but, someone you said,
So when you have something that is not correct,
oh, I
it gives
see.
you choices,
Gotcha.
and the different choices give you different like types of.
Right,
Forms.
different types of, yeah.
Mhm. So until you actually get the correct answer, you will actually go for the 100.
Okay, so it's hard for me to,
There is one in the homework,
okay, let's look at the homework.
W4P, which is number 14, chapter 4 assignments.
Fees for pension, isn't it?
Number 14?
And I mean, you have to try until actually you get the right answer or look into the book and stuff, but.
Yeah, so we did, if you look back at the, let me pull up the PowerPoints here. And I did kind of go through those faster. So on the PowerPoint.
That's what I was using to guide me for the answers.
Okay, so kind of starts with this returns quarterly and informational. 941, 943, 44, 45. Maybe it wasn't here. Oh, I think there was a section on W2s. Sorry, now I can't. Use W2C, W3C, correcting errors. Maybe the slides didn't talk about the W2. Well, it's. Oh, the W4s. Sorry. I can't even recall if we went over this. Here we go. Here you go. Withholding for pension or annuity payments, Form W4P.
There's the B.
And there's the government payments, Social Security benefits. There's the S, sick pay, and third-party pay. These are all going to show up on W-2s, but they're not for wages. For different. Or actually, the pension and annuity payments are not going to show up on a W-2, sorry. That's going to show up on a 1099. Their sick pay by third party shows up on a W-2. Social Security benefits are on a 1099 SA. But yeah, so that's where those come in. Does it say in your book? Was there anything in your book about these, or was it just from the slides?
I don't remember, because I was actually, when I was doing like the corrected, I was correcting my answers, I saw something like that too, that we haven't seen. I didn't pay attention.
Okay.
And I was looking into both the slides and the book, so I'm not sure exactly where.
Okay.
I got.
Okay. Well, I do remember going over this slide, but it was pretty fast as well. I was kind of buzzing through all of these different forms.
The whole edition has something.
Does it? Okay. All right. Does that help answer your question,
Yes.
Daniel? Okay. Other questions? on the homework? No? Okay. Let's see here. How about out there? Any other questions? Okay. Okay. Right on. So let's move along. Shall we? I don't want this one though. I want the other. All right, chapter 5. Can you believe it? We only had 2 chapters left. And then you're all going to be experts. All right. So chapter 5. This chapter covers unemployment taxes. And we don't really go into unemployment benefits, but just to kind of give you, I mean, I'm sure most of you are probably familiar with what unemployment benefits are, but for those who aren't, if you become unemployed through no fault of your own, meaning you didn't, like, if you got fired for cause, that's a different story. But if you become unemployed, then you are entitled to certain unemployment benefits for a period of time. The payments come from the state unemployment agency, depending upon what state you're in. And the rules governing unemployment as far as how long you can get those benefits and what the amount of benefits are varies from state to state. Okay, so it depends on what state you're in. If you've read through the chapter yet at all or taken a look at it, you'll see that there is a chart in the chapter that gives you details about each state and what their unemployment rules are. Now, that said, yes, the checks come from the state, but the federal government plays a part in this as well. The federal government administers the program, the federal unemployment program. So there are 2 parts to this, really. There's federal unemployment and then there's state unemployment agencies. Those 2 pieces work in conjunction with each other. The federal government collects taxes and the state collects taxes from employers. So employers pay these taxes to both the federal government and to the state. So there's these two regimes, FUTA and SUTA. So FUTA, F, stands for federal. SUTA, S, stands for state. Okay. So these 2 taxes, and you'll see when we go through and do the calculations for the taxes, companies pay much more in SUTA taxes than they do in FUTA taxes. The reason being that the FUTA taxes that are collected are not collected to actually pay benefits. They are collected in order to administer the program and provide oversight to each of the states and their unemployment programs. Federal government says you have to have some sort of unemployment program in your state, and the federal government approves the specifics of those state unemployment plans. But the federal government doesn't actually pay any benefits for unemployment. Now, there was an exception. During COVID, for the first time, the federal government did actually pay benefits. I think in most cases those benefits were they were paid by the state, but the federal government reimbursed the state for them. So there were but that's over with. It was, I don't know how long it lasted, a year, something like that. So that was kind of a hopefully one-time deal. That hadn't happened before. But now we're back to the old regime of the federal government administers the program. That's it. They don't pay benefits. States collect revenue, taxes from employers, and it's from those taxes that are collected that the benefits are paid to those terminated employees. Okay, so these two, and this stands for Federal Unemployment Tax Act, State Unemployment Tax Act. We kind of talked about that a little bit in chapter 1. This was one of those acts that was passed in the 30s during the Great Depression. So again, it was for labor protections. There was no unemployment compensation prior to that time. So these acts were enacted during that time. So in this chapter, we're going to look at both. Really, we're going to spend probably 60% of our time talking about the federal, and then the rest of it talking about the state. Okay. So we want to, again, we've got to figure out, okay, so it's based on income. The taxes that are assessed are based on income. So we've got to figure out, okay, what income are we talking about? How do we define that income? So just like when we defined income for Social Security and Medicare tax purposes, if we defined income for federal income tax purposes, we have to talk about what is income for unemployment tax purposes. Hint, it's mostly the same. It mostly falls under the same definition of what income are. So that's where we're going to define those taxable wages. And we're going to compute federal unemployment tax, and we're going to talk about state unemployment tax as well, and how that would be calculated using some examples. So on the federal side, there is this, and I will tell you, give you a heads up right now. This is probably the concept that confuses, oops, sorry. Now it doesn't. Really? I know that was me. I can't figure it out. This credit against the tax is probably the concept that confuses students the most. There is a tax rate, a flat tax rate actually, for federal unemployment tax, but if employers and the states in which they operate meet certain requirements, then that tax rate is reduced. They call that the credit against the tax, and it's actually reduced significantly. But this is probably the concept that confuses students the most. Because when we think of credit, we think we're getting a credit, we're going to reduce our tax rate. But how this is administered, everybody is assumed to get the full credit, but if they don't meet the requirements, some of that credit is taken away. So it actually increases the tax that's paid. But just to kind of give you a heads up when we talk about that. And credit reductions that may apply. For the state unemployment tax, or state unemployment compensation, we're going to talk about this experience rating system. How do we determine what the tax is for an employer? Because the rate that is paid is actually specific to that employer and only that employer. So, and it has to do, the rate that is determined has to do with how frequently former employees at that employer have requested unemployment benefits. That's the experience rating. So if they have a higher experience of employees being terminated and successfully collecting unemployment benefits, then the rate is going to go up for that employer. It's like insurance, right? You have a certain rate that you pay for your car insurance. If you get into an accident that's your fault, your rates are going to go up. You're going to be charged more because you're a higher risk. Same thing with the state unemployment. The employer who has more employees who have drawn benefits from that system, which means they've got a high turnover rate. And those employees have obviously successfully argued that they are entitled to unemployment benefits. That means that that employer is a higher risk. So they're going to pay a higher rate. They're going to pay more into the system because their employees are drawing more out of the system, right? So to keep it in balance. So that's the experience rating system. We'll go into more details about that. The reports that are required for FUTA tax, I've written it up here already, the 940 form. Luckily, it's only due once a year, so it's not a quarterly requirement that be. But again, we have different payment deadlines from reporting deadlines for the unemployment. And then information reports for the states as well. We'll look at Iowa in particular for the form that's required. The state forms are due on a quarterly basis. Okay, so I already talked about quite a bit of this. We've got FUTA and we've got SUTA. FUTA administers the program. It was formed under, it's part of the Social Security Act of 1935, but it is called the Federal Unemployment Tax Act. State Unemployment Tax Act was passed at the same time. All states, including the, what do they call them? Territories of the US, have enacted unemployment compensation laws. They have to be approved by the federal government, though. It's actually, so the Social Security Administration, in conjunction with the folks at FUTA, will approve those. Okay, meaning they've got to provide at least a minimum amount of benefits for a specified period of time. Right, so the federal government does have to approve those. Okay, so who is covered under FUTA? First off, it's only employers that pay this tax. Employees don't pay any part of this tax. The FUTA tax, I'm just talking about FUTA right now. Now, they probably indirectly pay for it in reduced wages, right? So if the employer's got to pay a tax on something, they're going to get that money from somewhere, right? So chances are wages are slightly lower as a result of it. But employees do not have any withholding of FUTA taxes. It's only the employer. If the employer pays wages of $1,500 more, and this is total wages, $1,500 or more during any calendar quarter in the current or preceding calendar year, or they employ, and this is a little bit convoluted, employ one or more people on at least some portion of one day, so even if it's only for 1 hour, in 20 or more calendar weeks during the current or preceding taxable year. So you'd look at 20 weeks first. Did we employ anybody in 20 or more calendar weeks this year or last year? Okay, we did. So were they employed at least some portion of one day? Okay, yeah, and it was one or more, yeah. So if either one of those is met, then the employer is liable for FUTA taxes. That doesn't mean that all of the wages that they pay are subject to those FUTA taxes, but the employer is now liable for reporting for FUTA taxes. So you can look at these, just kind of, well, I guess these are specific points. So the calendar week, how do we define that? 7 successive days, beginning with Sunday. Okay, so it's very specific, Sunday at midnight. 20 weeks do not need to be consecutive. So it could be 1 week, skip a week, next week, skip a week. So it just has to be during 20 weeks. And the employees do not need to be the same employees when using this test. Okay, don't get too hung up on this. You might have a homework question on it. There will not be an exam question asking you, okay, is this person, is this employee, do they meet the requirements? Okay. So who are considered employees? Regular, part-time, and temporary workers would be included, even if they just work for one day. So it also includes employees that are on vacation or taking sick leave. So if they're entitled to those benefits and they're using them. Members of a partnership are not considered to be employees. Remember this. I know that there are some questions regarding partnerships. So when they say members of a partnership, they mean partners in a partnership. Members is a term that's used for LLCs, which could be a type of partnership. But if you are a partner in a partnership, you are considered to be, just like with I think we talked about this a little bit with Social Security. So you're considered to be self-employed. If you're providing services to that partnership, you don't get a salary. You do get a salary, but they're not wages. So there's no withholding if you're a partner in a partnership. It's treated differently. Okay, so it's treated differently for FUTA purposes too. So partners, even if they're providing services, are not covered under FUTA. Okay, so they would not be entitled to receive unemployment benefits as partners, at least from that partnership. There are some special rules for agricultural and household employees.
Does this work like a 1099 kind of thing? Like your own employee?
So this being
The partnership.
So the partnership, so partners don't get 1099s. They get what's called K-1 forms. Partnerships are kind of a weird, type of entity. And if you take income tax, we do go over, at least on an introductory level, partnerships. But they don't, the income is treated like 1099 income in that the partner's gonna have to pay Social Security and Medicare tax on it. It's like they're self-employed, but it doesn't come on a 1099. It comes on a Form K-1. And those amounts are subject to self-employment tax. Yeah. And then, like I said, special rules for agricultural and household employees. Household employees being nannies, cooks, chauffeurs, gardeners. I'm sure all of you are familiar with having those types of employees. You don't, you do see them, I suppose. Like you would see, what I would mostly see are like nannies in the summertime. Like instead of sending your kid to a daycare, maybe you hire somebody to come in and take care of your child on a regular basis, and you're their only employer. People get in trouble for not paying the taxes on those employees because they are considered, oftentimes, depending on how much you pay them, they are considered employees. So, and the level is fairly low. I mean, it's like $2,000. So easy to pay somebody over the summer $2,000 to watch your kids on a daily basis. You're probably paying them more than that. They are considered to be employees. There are Supreme Court justices that have been derailed in they never became Supreme Court justices, but they have been individuals who were nominated to the U.S. Supreme Court, found out that they had nannies that they did not follow the rules on, didn't pay the taxes on, and they had to relinquish their nomination. So they were never, because they broke the law. It's awfully hard to have Supreme Court justices who have broken the law when they're supposed to uphold it. Anyway, so it's a big deal. It seems really obscure, but it actually happens quite frequently.
So like for nanny, do they receive like a 1099 or W-2 form?
They would get a W-2 because they're supposed to be, if they make a certain amount of money, they're supposed to be withholding as well. Mm-hmm. So it can, but it's not done like, those forms are not prepared. Well, the W-2 forms are prepared like any other W-2 form would be, but the employer doesn't file 941s or 940s. It's part of their individual income tax return. That's where they file and pay those taxes. So they do it once a year. So it's not like other companies that are doing it on a quarterly basis. right? It's done a little bit differently since it's just, it's an individual that is doing it. And that's one of those areas where, like, if somebody has a household employee, they really probably should have an accountant prepare their taxes for them, because then that accountant can also prepare the W-2s that would be necessary and all those other requirements, fulfill all those other requirements. Okay, so who is considered an employee? So we go back to that common law relationship. Same definition as under Social Security, Medicare, same definition as under federal income taxes. All comes down to control, right? Who controls those activities? Now, there are some certain classifications of employees that are specifically included and covered by FUTA, even if that control aspect doesn't exist, and certain classifications of employees who are specifically excluded that aren't covered by FUTA, despite that control, the specifics of who's controlling. So agent drivers or commission drivers who distribute food or beverage or deliver laundry, very specific category of employment. They are covered by FUTA, regardless of who controls. Traveling or city salespeople. And it says there are certain situations. Just don't get on who specifically, just know that there are some inclusions and some exclusions. Exclusions, casual laborers, so we're talking day laborers, would be excluded from being covered by FUTA. So if you're just, going to work for somebody for one day and that they're not going to bother with that. Partners, again, partners in a partnership are excluded, and directors of companies. So if you're on a board of a corporation, sort of thing. Also, foreign students and exchange visitors as well would also be excluded. Okay, so SUTA. So usually it's going to be the same people are covered under SUTA that were covered under FUTA. There is if covered under FUTA, ABC test. So there's this, I don't know where the ABC comes from. So when we're talking about SUTA, though, it gets a little weird because you might have employees who work in different states, right? So maybe they work, part of the time in Illinois and then part of the time in Iowa. So how do you determine where in which state is covering their SUTA? That's what they're talking about here. Yes, right there. So, and there are, I will tell you quite honestly, the ABC test is, I'm drawing a blank on the ABC test. Exclusion from SUTA coverage. Okay, I'm going to come back to that. I already started talking about this interstate employees. So there are four different kind of things that we look at with regarding which state is going to be taxing which activities of the employee. The first thing we look at is where is the work localized. So if you're only doing work in Illinois, then obviously Illinois is going to be where you are covered under SUTA. If we can't really determine, or it's just kind of all over the place, the location of the base of operations. So maybe your office is in Illinois, but you're divided between Illinois and Iowa with where you're actually doing the work. Well, your base of operations is in Illinois, so we're gonna put you under Illinois SUTA. If you still can't, and that's for the employee, if you still can't determine Exactly. That's there. Maybe there's no base really of operations for the employee because they're always in their car. Location of the place from which operations are directed or controlled. So where's their supervisor? Where's their supervisor located? We still can't determine that because maybe the supervisor, or maybe there is no supervisor, who knows? Location of employees' residence would be the final determining factor. Where do they live? That's where that's where they're going to be subject to SUTA. Right? It makes a difference because there, like I said, the rates are different from state to state. The benefits are different from state to state. So where somebody is located, under which state SUTA laws they operate, will make a difference both to the employee if they ever use those benefits and to the employer with regard to how much they're paying for SUTA. Okay. I don't know why I can't remember the ABC test. I'll write that down. We'll talk about it next. We'll talk about it on Tuesday. Okay. So if you still can't, by applying the order in the previous slide, coverage of interstate employees cannot be determined. There are arrangements that states will come to, agreements that states will come to with the employer. So the employer might be able to elect coverage of the employee in one particular state. Okay, so they can choose the state in which all services of interstate workers are to be covered based on the most advantageous wage base and contribution rate. So if we still can't determine where the employees are located, where they're covered under, is it Iowa or is it Illinois, the employer might be able to come to an arrangement with the state. And if Illinois is more favorable, maybe they'll come to an agreement with Illinois. If Iowa is more favorable, then they'll come to an agreement with Iowa. Once the employer chooses and the employee consents, so the employees have to agree to that, because we're talking about their benefits, right? If they were to become unemployed. The state would then approve the election of coverage. If the employee is transferred to another state during the same calendar year, the wages covered by unemployment compensation law of the previous state are included by the employer to determine the taxable wage base. We're going to talk about taxable wage base when we do some calculations, but what that means is the employer, so I worked in Illinois for half of the year. I moved to Iowa and I'm still working for the same employer, but now my area of localization is in Iowa. My employer can apply the taxes they already paid to Illinois to the taxes that would be due in Iowa. Okay, so that's what they're talking about with regard to that. Overseas workers, I'm just gonna real quick here. If they work for a US company, then they're covered by FUTA laws. Okay, if they work for a foreign company, they are not. So these are people who are overseas. Okay, so I don't know, you live in France and you work for Amazon. Amazon's an American company, you would be covered under FUTA. They would have to pay FUTA taxes for you because you're an American citizen working for an American company, even though you happen to be located overseas. You're working for the French government, you don't have to, there's no FUTA tax that would apply. Probably there are some other taxes that apply under French laws. Let's see, state of employer's principal, if you are covered, so it would be under the state of their principal place of business. I don't know where Amazon's principal place of business is, but let's just say, are they Texas?
I thought it was Oregon.
Could be. Okay, we'll call it Oregon. So they would be, if you're, even though you're living in France, you're an American citizen, you're working for Amazon in France, you would be covered under the Oregon unemployment laws, right? If it can't be determined, it's the state of incorporation or the owner's state of residence. Well, if you've got a corporation that's publicly traded, you've got a bunch of owners. So wherever it's incorporated. So for many of them, it would be Delaware because that's where they all seem to be incorporated. So benefits is about as deep as we get as far as benefits go. You have to have earned a minimum amount during a specified period of time. So you can't just go work for a company for one day, get terminated or laid off, and then go collect unemployment benefits, right? You have to have actually worked there for a certain period of time and earned a certain amount of money. And then each of the states have their own requirements as well as to when employees, so some states will say you become immediately eligible for benefits. So on day one, other states have a waiting period as well.
Question on that.
Mhm.
So benefits, does the employer determines when will you get them or the state?
The rules of the state, the laws of the state would determine when they would get them. Yep. A lot of employers will fight benefits. They will disagree with if an employee makes a claim for benefits, there are a lot of employers that will what's the word I'm looking for? I'm drawing a blank on many things today. So they'll fight them. They'll say, no, this employee doesn't deserve, like maybe they intended to get fired. Somebody just helped me with
When
my
they think they're not gonna
vocabulary.
last.
What's that?
When they think they're not gonna last.
Dispute, right? Dispute. Thank you, Lisa. Yes. So, like I said, you can't game the system and intentionally get yourself fired in order to get unemployment benefits, right? There has to be a reason that was beyond your control. Kind of like if you got laid off, that would be a reason that you might be able to claim those benefits. But employers will oftentimes dispute. Thank you, Lisa. Dispute those benefits. Yeah, Lisa.
Well, this probably doesn't have anything to do with class, but well, sort of what we're talking about right now, and only because it really burned my biscuit, it made me really, really, really quite angry.
Uh-huh.
I've worked for about 45 years. My
Mhm.
last job I had for 39 years, the office closed. This was
Mhm.
before COVID. When I had to wait 2 years to get unemployment, they said that they would give me unemployment for a year and a half. So don't even worry after the year to go ahead and apply again. Well,
Mhm.
I did not get unemployment for a year because COVID started. And then that's when the governor said all these lazy people are unemployment. So after working 45
You gotta
years,
get
I did
caught.
not even get 1 year of unemployment, which pissed me off because I'm not lazy.
Mhm.
So that's all.
Yeah.
I just had to say that.
Did you work for Dolls? Do I remember that right?
Nope, not Dawes. I worked for CenturyLink. Well, the last
Oh,
name they had was CenturyLink. I started way back at Northwestern Bell. So
gotcha. Gotcha.
that's what they said. Don't worry, a year and a half. And I mean, I did not even get a year. I know people that worked for 3 years and got a year and a half of unemployment. So if I
Yeah.
worked 39 years, how come I can't get a year and a half of employment? But well, the last job, because I gave unemployment. Well, anyway, go ahead. I'm just pissed me off, and I'm still pissed about
Yeah,
it.
I think there might be a little confusion there between unemployment and severance. Because oftentimes, if somebody is dismissed from employment, or maybe they're asked to retire early, they're given some sort of severance package in exchange for that. Because the unemployment benefit, although during COVID it was different, it just went on and on. Right now in Iowa, I think you're limited to 26 weeks of unemployment benefits. So I'm going to end there. Again, I kept you 2 minutes over. We will pick up on Tuesday. I'll give you some more information about that ABC test first off. And then we'll start looking at some calculations for FUTA. Okay. Actually got through everything I expected to get through. That doesn't always happen.
We did fewer questions.
That's right. That's right.